any conversation.
Oh, I don't know.
So I was like,
I did not share my screen. Yeah, let's not record that.
I ran with Drew.
Okay.
Exactly.
All right, so let me go back.
The audience wants to hear.
Let me go back into this part again. Treasury stock or stock shares that a corporation has bought back. They're their own shares. You've got the 3 reasons they might do that. And just remember there's no dividends on Treasury stock. They don't pay dividends on their own shares of stock. Okay, so we had read this. I forgot to hit record. Thank you, Pablo. All right, so in this problem, we have a corporation with the following paid-in capital. We've got common stock, 20,000 shares authorized and issued, and paid-in capital in excess of par common stock. So they tell us on February 3rd, the corporation purchases 1,000 shares of its own common stock. So it's rebuying its stock off the market. And I was telling the class before I hit record that they have to pay the same price as anybody else would to buy these shares back. So $45 is what the market price was the day they repurchased their shares. And then they resell 600 on April 29th, and October 4th, they resell 400. So we'll look at the entries required to record all this. Okay, so on February 13th, we're going to debit Treasury stock, and Treasury stock has a debit balance. It looks funny on the balance sheet because you got everything else that's just a regular balance, and then you have some brackets around. It's kind of like accumulated depreciation, kind of looks funny. But Treasury stock has a reduction in equity, so we required 1,000 shares, and they had to pay $45 a share on those 1,000 shares they bought back. So their total amount that's going into Treasury stock is $45,000, and then we'll credit cash for the same amount. All right, when they say that we use the cost method to record entries with Treasury stock, this is what they're talking about. The $45 a share, that is the cost. So whenever we debit or credit Treasury stock on any of these entries, we'll always use $45 a share to calculate what we're doing to Treasury stock. Okay, April 29th, they sell 600 shares. So we'll be debiting cash. We've got 600 shares that are being sold times the sales price of 60. Oh, please. I hate that. I barely touch the thing. Can't get it to do what I want it to when I actually put my hands on it. And then, okay, so the sales price is $36,000 because we're using this right here. That's the same thing as when you see a issue where it says they sold them at. So they sold them for $60 a share. All right, so we'll credit Treasury stock for 600 shares times what? What amount? 45. Because that's your cost. Okay, so we'll credit 27,000. And so the difference to make the entry balance is a credit of 9. So we will be using paid-in capital. Okay, see that. It's a hyphenated word, but you can put PIC. Paid-in capital from sale of Treasury stock. Now, what's different about this paid-in capital account is you can actually debit or credit that paid-in capital account because you're going to see the next entry, they sell the remaining shares at an amount that's less than what they paid for them. But we still got to get them out of the Treasury stock account at cost. All right, October 4th, we've got a sale of the rest of the shares. 400 shares times $40. because the price, you know, it's going to fluctuate from day to day, so it might go up, might go down. So we were putting $16,000 in cash, and then treasury stock we will credit for cost. So that is 400 shares times $45, which is $18,000. So what do we need to get this entry to balance?
We got a debit fee.
Yeah, we do. You got to have a debit, and it's going to be to that paid in capital account. So this will be the only one you see that with, but because we're not using like par value, we're using a different value that, you know, the sales price can go up and down, which it would for just issuing regular stock as well, but you're not, you're using an amount that's different from par, so you could have a lower amount that you end up selling it for. Par is usually so low that you're going to sell it for more than par. Okay, one thing I showed the 8 o'clock class too was just to kind of visualize this, so you can see what we're doing. Y'all remember any of this? T charts, T accounts?
Mm-hmm.
Yeah, maybe.
On the persons you did, so yes.
Well, that's what I'm saying. It's been a minute, so I probably would have forgotten by now. Okay, so February 13th, we debited treasury stock for 45. Then when we went to sell it, we credited 27, and then we credited 18 for the third sale. So what's my balance in treasury stock?
45. Or 0.
You got a $45,000 debit, and then how much are your credits?
45,000.
So your balance is 0. And that's what we want. If you sell them all, we want to zero the thing out. We don't want to leave some odd amount in there. That's what we use the paid in capital account. So like our paid in capital account, we had a $9,000 credit and then a $2,000 debit. So we
a normal credit balance.
We still got a $7,000 credit balance, but you could debit. It could wind up, I guess, with a debit balance, depending on.
But a credit balance is positive.
That's what would be typical.
Whereas if you have
because it's an equity account.
money.
But you know, treasury stock's an equity account and it's got a normal debit balance. But it's because you're buying your shares back. You're reducing your equity. You're giving up cash and pulling your equity back in. So does that make sense to everybody?
So you make sense to me?
All right, example 2, May 3rd, Bengal Corporation reacquired 3,500 shares rather. So look for the words reacquired and it's common stock. So that tells you it's a treasury stock entry. So $48 per share is their cost. And then they go through selling the shares back. So let's see what this one looks like. May 3rd, we're gonna debit cash. No, I'm sorry. Debit treasury stock, sorry. I'm so used to doing the issue. Okay, so how much am I gonna debit my treasury stock for?
That's 168.
3,500 shares times $48 a share. How much is it? I'm sorry.
168.
And then we'll credit cash because we're paying for it. Okay, on July 22nd, hearing things or y'all? So debit cash, $2,000 times 53, which is your sales price per share. So that is 106,000. All right. So what will we do for the rest of the entry?
Treasury stock.
Treasury stock.
I'm sorry, I'm looking at that.
So, how much is this? 2,000 shares times what amount?
48.
48. That's 96,000. And then we have to balance the entry. So we've got 10,000 paid in capital from sale of treasury stock. That make sense? I'm totally distracted y'all. I'm like thinking off cool or something. But you got it?
Oh, no. Yeah, sure.
Was your hand raised?
No. Stood up.
You're fed up?
Sped up.
So yes, I can hear for the most part, but can't always understand.
Yeah,
I like to blame it on y'all.
Like I said, fed up.
What you fed up with?
I love him.
Do what?
I said I love him.
You don't have to lie. I mean, I didn't like.
I'm not lying, it's the truth.
I didn't create accounting, so if you don't like it, well, I kind of felt like it. There was a touch of sarcasm, maybe just
I'm very sarcastic.
just a hint.
Yes.
Well,
Always.
my entire family is sarcastic, so usually I default to thinking someone is being sarcastic. Okay, so the rest of the shares were sold, which is how many? Started out with 3,500, purchased
1,500.
back, yeah. 2,000 have already been sold, so we're going to sell the other 1,500 for how much?
45.
$45 a share. I mean, so already you can tell you're going to have a difference here that's, and you know, when y'all are doing Cengage, you may want to like skip the middle line because this is, you're going to end up with another debit. I kind of like to do things in the same order, so I wanted to put treasury stock next. And we'll say 1,500 times $48 a share, because that's the cost. And that's a credit of 72,000. So my paid in capital from sale of treasury stock essentially will be 1,500 shares times $3 a share, because that's the difference between your cost and your sales price. But we need a debit, so we'll have to debit paid in capital $4,500. So it's all right to debit, but just make sure when you're doing your homework that you put all the debits first, then the credits. Okay. Y'all work this one and see if you're getting it. Because these are the parts you like to fast forward past.
What?
When you're watching it, you can fast forward past the parts where y'all are sitting here doing stuff. Again, this stuff I write in parentheses is just so you'll know where the numbers come from. You don't ever have to write those on a test or anything. You get that? Did you work on it? Any questions on any of it? Make sense? All right, so we're going to move on to the next part, reporting stockholders' equity. All right, so there's two ways you can do it on the balance sheet. You can have each class of stock reported with its paid-in capital accounts, and then once you've reported both classes with their paid-in capital accounts, you show retained earnings and then a deduction for treasury stock. The second way is just to show the stock accounts with a total paid-in capital as one item, and then retained earnings followed by the deduction for treasury stock. All right, reporting retained earnings. So there's three different ways you can report retained earnings. You can do an entirely separate retained earnings statement. You can combine the retained earnings statement with the income statement, or or you can do a statement of stockholders' equity. There might be restrictions on retained earnings. So they could be legal. Some state laws make these corporations keep a certain amount of capital. Let's skip that one part. All right. The board of directors might restrict it. Those are called appropriations when they do that. And they have to be disclosed in the notes to the financial statements. Y'all never saw notes to the financial statements. That's like, all we ever did in accounting one was income statement, statement of owner's equity, balance sheet. When you've got a really big corporation like this, they'll have a number of pages following those financials that are called notes to the financial statements. It has detail in it. So, like, let's say the notes payable balance on the balance sheet is $1 million. Well, you can flip back and it'll refer to like note number 3. So you'll flip to the notes, note number 3, it gives you the breakdown of who the loans are with, what the payments are, interest rates, when they'll be paid out, etc. So that's just one note you might see. There's lots, but that's what it's talking about. If your retained earnings is restricted, there'll be a note in the notes to the financials indicating so. So, legal restrictions, laws for some states require that these corporations keep enough in there to cover, vendor accounts and stuff like that, so that vendors don't get, I guess, they don't get stuck with a bill because they've issued too many dividends, And so usually they restrict it to the Treasury stock balance. And that way, that particular amount can't be used to pay out dividends. Could be contractual, like maybe they have a loan with the bank and it said, the terms of the loan are, you can't deplete your retained earnings past this point. Discretionary. That's something voluntary the corporation decides to do. And they might do that so that they can expand or something. One of you right here. I guess you have to, not if your back's doing. If you're in reach.
Single.
You and I both probably still got antibodies, so I'm not worried about you being in my face.
Yeah,
I still use
You still have it? I mean, you had it already? Where'd you have it? You had it back for me.
Never got this.
Me too, and it's not back. Somewhat. But
finally came back.
it's back, but it's not 100%. Like, I used to have like a really sharp sense of smell, and now it's kind of like,
But I still haven't. But I still haven't gotten.
it'll come back eventually. It's just weird. Okay, prior period adjustments. These are adjustments that relate to, let's say you are in, like your year ends in December and maybe February or March, or you're looking at your inventory or something and you find that oops, when we were making this adjustment at the end of the year last year, we messed up. We multiplied wrong. And so whatever mistake you find doesn't relate to this year, it relates to last year. So, we've talked about that before. You want everything in this year to be from this year. You don't want to commingle your periods together because then you can't really tell how the business is doing. That was kind of like we were talking about inventory and doing that allowance for returns, and like Walmart, they may sell something in December that, as a Christmas gift, and they bring it back in January. Well, you don't want January affected by returns of December sales. So it's kind of the same thing. You want to match them up. So what you do is you make an adjustment to retained earnings so that it doesn't show up on your current year income and expenses. Honestly, just know about it. I mean, I don't like the examples they have. I wasn't crazy about, and they're kind of hard to decipher. And this kind of stuff like that. I mean, get into that in a higher level accounting course. I mean, we can like address it or whatever, but I don't think we need to spend a whole lot of time talking about it. All right. So let's see. Statement of stockholders' equity. We're going to use that statement when there are changes in stock and you're paid in capital, along with dividends and net income and all that kind of stuff, because it's more to report. So statement of stockholders' equity is it's a more detailed report. Now, if you only have net income and dividends, if you don't have any stock sales or anything like that, you can do a retained earnings statement. It's a lot shorter. So you hope that there's not a lot of that if you're the one preparing this stuff. All right, earnings per share, we're just going to talk about real quick. I don't even think I gave y'all homework on that. Chapter 17, we do all this kind of stuff. We do a lot of calculations of ratios and these kind of numbers. Earnings per share is not the same thing we did at the first of the chapter. That was dividends per share. So that calculates for each share that's out there, how much are you paying in dividends? This is related to net income. So for each share, how much net income is related to. So I don't know that I want to include it in there. It gets confusing. I don't want to, there's no point in adding it. Here we'll hit it in chapter 17. All right, so sometimes this is called basic earnings per share. It's calculated on common stock. We don't throw preferred in there. And it has to be reported on the income statement. All right. So now we're going to have a really fun time doing these statements. In your homework, you'll see, and I kind of worded these examples the same way so you would see what I was talking about. In fact, some of these things are actually problems from previous years. But it says, using the following accounts and balances, prepare the stockholders' equity section using method 1 of exhibit 8. Are y'all listening to me? Method 1 of exhibit 8. That's it. That's method 1 of exhibit 8. I put it in here for you so you wouldn't be hunting around for it. And we're about to do one so you can also use our example. But that's what they're talking about. Because using their example just wasn't just a whole lot of fun. But I erased this already. And writing these over and over is not a whole lot of fun either. And I'm afraid if I just put it up there for y'all to copy, you won't really. You kind of zone out and just copy things down. I think you probably gonna do that anyway, but you know, I'll take my chances. Now, you will have homework where you have to prepare these. On a test, more than likely, we're just going to do a statement of retained earnings because it doesn't take as much time. Y'all don't have as much time. So I don't want to put something really lengthy on there that you've got to try to regurgitate. So. Two statements, yeah. And then the chapter's over. And I did tell y'all we're having test next Thursday, right? Yep. I've got to get the sign up ready. I'll try to get that done today so y'all can go ahead and snag spots. Oh, this is supposed to have a C in it. I missed that when I was typing. I didn't catch my typo. So that's supposed to be stockholders equity with a C, not just the gate. Yeah, it looks like Nordic or something in there. Stockholders. I actually went back in and found the work papers for this thing, so the ones that kind of look like our journal entries and stuff, because this is so small. You have to write really, really tiny, or just use a whole bunch of lines, and it was no better. So, and I actually corrected my spelling on that one. Okay, so what we're doing here, we are using this information here. We're going to prepare the stockholders' equity section of the balance sheet. So that's just the bottom part. You've got assets, you've got liabilities. What is so funny? I'm going to make you come up here and tell everybody.
I just love accounting.
I know, you're all happy about something, so. I may look stupid. But. stupid and goofy,
I was
whatever.
laughing at that.
I
Mhm.
wonder if Pronto lets you send meetings.
Hmm?
I wonder if Pronto lets you send images.
Oh, yeah. You can attach all kinds of stuff in there.
Oh, good.
So be nice to each other. If you're gonna send something ugly, direct message it to each other. Don't put it on the group.
No, I meant like no. This would be funny if like a picture comes up right now.
Gotcha. All right. So remember, all we're looking at is this particular section because your assets and your liability section, they're not going to be any different. This is very different. So we're just kind of chopping off this bottom part and doing that. So if you want to just write, you don't have to do this, but I wrote it up there just to remind me that this is only this particular section of the balance sheet that we're looking at. And the apostrophe goes after the S because stockholders is plural. Okay. The first thing we're going to report is paid in capital. I mean, one thing that this does do is kind of show you what is included. Like at the first of the chapter, when you're reading and it tells you what all is part of paid in capital. I mean, that doesn't stick. You've never heard of most of this stuff before. But doing this statement and seeing what's actually part of paid in capital will help it stick a little better, I think. All right, so our paid in capital is made up of common stock, and really, you really do have to you have to write all this stuff. I'm thinking about typing it in a computer. You really have to include all this on your description. Okay, so we've got to, first of all, you got to put the number of shares authorized and the number of shares issued. So watch when you're doing your homework. I don't know why they chose to write that out in words and then put the other one in numbers. Because if you're not paying attention to it, you may not realize it's inconsistent. That kind of stuff bugs me. Why didn't they just put 40,000? It's a typo and nobody caught it again, I think, in this edition. So they got 40,000 shares of common stock are authorized. So their charter said they could issue up to 40,000 shares. And we've had 5,000 shares that have been reacquired, which would be called what? Treasury stock. So how many shares have we got outstanding? How could we figure that out? Or issued?
Subtract.
Well, you could, but you can also take this 1,500,000 and divide that by $50 par. And that will tell you how many shares you've got issued. Because all they're telling you is authorized and reacquired. We don't know how many were ever issued. I think it's 30.
Yes.
So that tells you that you have 30,000 shares issued. All right, so that's part of our description here. We have 40,000 shares authorized. $30,000 shares issued. What does issued mean? Sold at some point, and they may not still be. There's a difference between issued and outstanding. Issued means at some point they were transferred to the hands of a shareholder. Outstanding means how many shares are right now in the hands of a shareholder. So you could take the 30,000 issued and subtract the 5,000 that have been reacquired, and that will tell you that you have 25,000 outstanding. So that's when you would subtract if you were trying to figure out outstanding. I really thought the outstanding shares had to be listed on there too, but we're not gonna do that. So that's 1,500,000 that comes from these numbers at the top. Common stock is 1,500,000. You just have to write this really long description. All right, so the next thing is excess over par. So this is our paid-in capital and excess over par common stock. That's what this number is. But we've already got it listed in the paid-in capital section, so we don't need to write all of that. And it's 160, it's at the top. All right, so we'll total these two. Get 1,660,000. And that total we are going to call paid-in capital common stock. So if nothing else, you know, you can see that paid-in capital consists of common stock, the excess over par, you know, so it's not just the paid-in capital account, it's also the common stock or the preferred stock too. They just don't have any. All right, so the next thing we will do, we've got paid-in capital from sale of treasury stock that we're going to list next. Everything we've listed so far relates to common stock, so we had to get total number for common stock. Now we're going to list the paid-in capital from the sale of treasury stock because we actually have some paid-in capital. All right, so we'll add those two together. Y'all want one of these on your test?
No.
Just take some. So this is your total paid-in capital. Okay, so the next thing we will list is retained earnings. And that amount is $4,395,000. So remind me what retained earnings is. Anyone? It's like the cumulative net income and net loss over the whole life of the business, and it's been decreased by dividends. So you've got the net income, net loss, and all the dividends paid out, that cumulative number over time. Does that make sense? If you were to add up net income or net loss from every year and subtract out dividends from every year, that would be the retained earnings. It's just what it says, but it's kind of hard to visualize. All right, then we're going to list our treasury stock. And that we're just going to describe as 5,000 shares at cost. Now that's a deduction. Remember, we were debiting treasury stock, so they still got some that they're holding. And then combine these three numbers, 1,704,000, 4,395,000, and subtract the 120, and you get 5,979,000, and that is total stockholders' equity. And this is like the bottom section of the balance sheet. So instead of just putting Chris Clark Capital or something like that, you got to put all this. It's kind of a pain. Okay, next page, y'all got you work this one, we're going to skip it. Now, what I would suggest is if, you know, you can do it or not. I mean, that's up to you. We're going to have a retained earnings statement. If you work this one, you might want to save that one to like study with.
So we're done?
No. One more. This one's short though.
So
Are you ready to leave?
Yes. We gotta go with Madison.
Oh, when y'all gotta go? Okay. Here.
Well,
I'm running through that, so. We'll find the answer.
I was 12:20.
All right, look. here's what we've got. We got retained earnings, beginning number, net income, and then our dividends in total. This is like your statement of owner's equity. You take your beginning number, add net income, think of dividends declared as withdrawals.
25, 26.
This is page 25. And then you come out with your ending retained earnings. So just make sure you know what to put where and how to construct one from the information given to you. Because that'll probably be on your test, but that's not lengthy.
Are we gonna need to know this on part? Or write all that out?
This,
Yeah.
yeah, that's the heading. That's the heading of the statement. Usually I have that other format with the lines and stuff. Yeah, this is your heading. It's just like any of the other statements. You put the company name, the name of the statement, and then the period that's covered.
It's not a balance sheet account. Or it's not a balance sheet thing, so you.
Well, this is like, you've done the income statement. This is in lieu of your statement of owner's equity. You're gonna do this, and then that gives you your ending retained earnings to put on your balance sheet. So your balance sheet, you gotta get the ending retained earnings number to put on there. So more than likely, if you're using this, there's been no changes in stock or paid in capital in this year. It's a lot simpler. Y'all need to tell me when y'all gotta go somewhere. If y'all need to leave early, you leave. I don't mind. I mean, it's just, where y'all going? Y'all got a game today?
No, we're gonna get tomorrow. Practice in mass next.
Why?
It's actually in both.
It's an indoor team. Yes. Remember,
So have y'all been to cryotherapy?
do you
Right that
have,
way?
do you have Haley in your class?
Like 4 crowd there?
In Madison somewhere.
Harrison Haley?
Mm-mm.
You ever had it?
No, a friend of my next door neighbor's son got a ticket on 55. He and a carload of baseball players are going to get cryotherapy or something in Madison.
Teachers are on my house.
Don't get a ticket in Jackson. Because they won't. They don't care. They don't want to listen to you. They gonna give you the ticket. She was like, "Can Jim do anything about this?" I was like, "Probably not. Not in Jackson." That and a park ranger, Lord have mercy. Those are expensive. Don't get a ticket on the trace. Y'all ever drive the trace?
Oh.
What is it? 50?
Don't
Don't
go
go.
that speed limit.
I mean, maybe 55, but don't push it. Those are expensive tickets. That's federal. That's a federal offense. So if you don't pay your ticket and they come to get you. All right, I'm done with y'all. So we'll do review on Tuesday. You've got homework to do. Huh? If we have time. I mean, I
I
don't
won't be
know.
here anyway.
Huh? We don't have time. And I'll put those sign-up sheets out for y'all, and I'll post an announcement when I do, so you can sign up for your time. If there's not a time that agrees with your life schedule, then you'll have to let me know. All right. Y'all have a good day.
Oh, Tom's ready to go.
Huh?
Tom's ready to go.
Yeah.